Today, my guest is Ben Leybovich. Ben is a frequent contributor on Bigger Pockets. He's the founder of Cash Flow Freedom University. And also, you can check him out on his website, real estate learning platform, Just Ask Ben Why. He's also the host of the new podcast, Multifamily Syndication Unscripted. And today we're going to speak with Ben about multifamily syndication. But first, a quick reminder, if you like the show, we would love to hear from you. Please let us know. You can like, share, and subscribe. And you can also leave a comment there. We'd love to hear from you about what you like about the show. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. That's Commercial Real Estate Pro Network. With that, I want to welcome my guest. Ben, welcome to CREPN Radio.
Ben, thank you so much. Pleasure to be with you. And I noticed that last comment about how good looking your guests are. It never worked before. In all the previous podcasts, it made zero difference. But now that Ben Leybovich is here, and everybody knows how increasingly good looking I am, everybody's just gonna your website or your YouTube is gonna go down because of the traffic.
We're gonna crash YouTube here because we've got Ben on the YouTube there. So, but we'll take that risk.
It's a pleasure to be with you.
Yeah. All right. Well, hey, Ben, as we were talking just a little bit before, and just a little brief intro I provided there, if you could take just a minute and share with the listeners a little bit about your background.
I was born in Russia, it was still Soviet Union, but literally within 6 months after I escaped, it became Russia. It was pretty surreal to see the tanks and the Red Square and the whole coup and everything else. And I was in America just days when I saw that on TV. I played violin since the age of 5. I went to Cincinnati Conservatory for years and years, discovered I had a medical condition, received the diagnosis of multiple sclerosis. A doctor said, don't do anything stupid, but probably, standing on stage or sitting on stage and utilizing fine motor skill with this kind of diagnosis may not be the best idea as to how to make money. So a lot of research led me to real estate, some single family, a lot of multifamily, and now I syndicate apartments. I've been doing that since I moved to Arizona about 3 years ago.
Got it.
I think I currently manage, I don't want to tell you wrong. Let me think. $21-22 million by acquisition. Who knows what the market, I buy value add. So, who knows what the market capitalization is, but there it is.
Right. And did I understand too that you focus primarily in the Phoenix market? Is that your primary?
Yeah, right. I still have a portfolio in Ohio from the stuff that I did before, but right now I buy strictly in Phoenix.
Gotcha. And for our listeners, the majority of our listeners are real estate investors or recognize real estate as a vehicle they want to invest in. And with that, I wanted to talk a little bit with you about syndication. Obviously, you're a syndicator. And I'm wondering if, just as a kind of a starting point, if you could just take a minute and define syndication from your vantage point, how you define syndication.
Well, if you look in the dictionary, the word to syndicate means to pull together, whether it be funds or skill sets or whatever. Relative to real estate, we use the word syndication. It's practically a slang type term, but essentially what we're doing is we pool capital together. There are several vehicles via the Regulation D, which is an exclusion in the SEC code, that we're able to pull capital together in order to acquire these big assets. Today, Sam and I are in the highest and best, for instance, and we're submitting an offer, and it's going to be a $19 million offer. Those kinds of things, it's just the ultimate, you saying together with people, we can do much more than trying to do it on your own. Uh, and that's just kind of an example, maybe perhaps an extreme example, but that's what happens. 10 million, 15 million, 20 million, 50 million, those kind of big numbers. But structurally in the syndication, what you have is it's essentially a limited partnership. So I'm not an attorney, so nothing of what I say here is legal advice or to be received as such or perceived as such or what have you. But generally speaking, in a partnership, you have two types of partnerships. You have something that slang refers to as a democracy, and then you have a limited partnership on this side. So the democracy partnership is me and Darren coming together and saying, hey, let's buy a 24-unit building. It's going to cost us, $100,000 a door, so 2.4 million. You do half of the down payment. I'll do the other half of the down payment. We own it 50-50. We'll do a partnership. We know each other. We like each other. We make decisions well together. And so, we won't argue what flooring to use or what faucets to put in or what have you, how to gold plate our toilets, right? We like each other. We agree each other. We've worked with each other before and we're good. Okay. That's a democracy. Both of us have a vote. And in order not to get stuck, you better make sure you really like the other person. Well, Darren and I coming together couldn't do a $20 million deal. And for me personally, it doesn't make any sense to do a $2 million deal. So then where does that leave you? Well, that leaves you with a vehicle, basically a limited partnership. In a limited partnership, you have someone or a group of people running the deal, the general partners. And then you have the limited partners, which are people bringing basically the money, the equity to the deal. The big difference is limited partners don't have a vote on the day-to-day operations of this thing. And what happens when you take votes away from people essentially is you're creating a security, because now this person has money invested with an expectation of a return on that investment, and yet they don't have any say in what's going on. Well, that basically defines security. And so when you get into these kinds of situations, you have to do it very properly. You have to do it by the book with paying attorneys $20,000 to create SEC paperwork and filings and everything else, right? So it's essentially a partnership. The intent of the partnership is to pool the capital together and invest in an asset which is going to appreciate and cash flow and all that stuff and create investment returns. And for that, you're paying the general partner basically a cut of that return in order to run the deal. And that's kind of the 10,000, foot in the air, bird's eye view of very basic dynamics of what we do.
Want to back up just one step here, and I probably should ask you this before, but you mentioned that you had invested prior to doing syndication. And it sounded like there was anything from single family to smaller multifamilies. Can you speak to what was your reason to move into syndication?
Well, there's a mathematical way to answer that question, an empirical, data-driven way to answer that question. There's also a liberal arts way to answer that question. So I kind of do it both ways and see which one speaks to who. People are different. So liberal arts wise, I had a mentor at one point. He's no longer with me. But, I think it's fair to say that I far superseded his intellectual worth relative to real estate as a vehicle, the dynamics, the mechanics, all of that. But spiritually, a lot of his lessons are still with me and still guide my decision-making process. Well, one of those lessons was, once upon a time, I'd ask him, how do I know if I'm moving in the right direction? And he basically just told me, just make sure that every step you do is a little bigger, a little better. That will structurally guarantee that you are moving, you're growing in the right direction. So that's a very liberal arts approach to say that, hey, yeah, okay, so I bought a single family. Let's do a duplex. Now I've done it. Why bother? Let's do a triplex. Now I've done that. Let's do a fourplex. Now let's do a 6 unit. Now let's do a 10 unit. That kind of line of thinking. Now, if you switch over to the mathematical side of things, um, and this, well, first of all, I don't want to manage property because my time is worth a lot more than that. So that's one thing. It's a chicken and the egg argument. You can't possibly do what I do now without having done what I did before. Because in order to do what I do now, you have to have a very clear and a very internalized understanding of how people behave, how markets behave, and how assets behave, and how all three interact. Without having lived that life for a decade, I'm not sure that I would be any good as a syndicator. Okay, so that's just something where there's a lot of gurus running around. Oh, you can syndicate your building in the next 3 weeks. A lot of bullshit. You really shouldn't, because you just don't know. Book smarts get you about 20% there. The other 80% comes from being able to ask a question. Why is this going to behave this way and not a different way? Well, the answer to that question comes from the rear view mirror, because you've seen it behave that way, because you've seen that interaction, okay? And book smarts don't get you there. So you don't know what a good deal looks like, even if it hits you in the head. But I digressed. So the reason I grew is because it was important to me to grow. As a human being, I will shoot myself first before I could buy 200 duplexes. I could, but I'll shoot myself. I wouldn't be able to look myself in the mirror.
Right.
This isn't about the money. At a certain point, a human being has to grow. And it's not the bank account necessarily that has to grow. It's the intellectual worth. So for a guy who is in his brain a syndicator, poised and ready and willing and able to buy 100, 150, 200 units, for that guy, it is totally detrimental, completely kills your sense of self, kills your self-worth to be buying duplexes, even though it's easy and it works to a certain extent, right? So that's kind of the liberal arts. And then mathematically speaking, it's just a lot more expensive to run smaller property.
No, that's a pretty succinct answer there for the mathematical side of things, the expense. So moving from your smaller properties and getting into the syndication, what was the experience? I mean, did you when you I mean, have you taken a property from beginning to value add and sale, or where are you at in the process of your 3 years of syndication?
So the last building that I had bought that was not syndicated was in 2013, and it was still in Ohio. And then I realized that even though I could continue doing the same thing, it's just not what I see my life being. I just wouldn't be happy as a person. Even if it does make sense financially, I just needed to do something else. It took me about, let's see, 13. I spent about a year repositioning that. So that put me in 14. And then I sat down trying to figure out what to do. And then it literally took me about 4 years of studying and modeling and trying to understand multifamily. I bought my first one syndicated, meaning 8 months ago. So that's in the process of the repositioning right now. The second one I just bought, Sam Grooms is my partner. We bought 2 months ago, and now we're making an offer on hopefully what will become our third one. So no, we do not have an exit. the exit plan is 3 to 5 years. The underwriting is 10 years. We would exit sooner, but we're just not there. Where it's very methodical. You price your exits relative to what your business plan is, and we're executing the business plan. We would be, if we exited too soon, would be leaving too much money on the table. So it doesn't make very much sense.
Gotcha. Wonder if you could speak a little bit about the getting in and getting out of a syndication. So you mentioned the pooling of investors, their money, getting together, and you mentioned a little bit about the limited partners and that they don't have a vote, but essentially they've trusted you, they've committed to you. You've got all the legal documents in place, and you mentioned kind of the 3 to 5 year window. Can you speak a little bit about kind of the projections and kind of the anticipated end
Sure.
of the deal?
Sure. So this might take a little bit because we have to go all the way back to the beginning. So the question being asked, is a syndicated multifamily deal a cash flow deal and should be seen as a cash flow deal, or is it something else? And to answer that question, we have to acknowledge certain realities. One of those realities is, if you haven't owned property for 4 years or more, and hopefully 8 years or more, you've not experienced what's called a capital expense cycle. Capital expense cycle is a function of mechanicals as they're being used and abused. They get old. Everything from your furnace to your water heater, your flooring, your paint, your cabinets, your lighting, your plumbing, everything. Okay. Well, there's such a thing as a capex cycle. The tax people capitalize or not capitalize. What's the word I'm looking for? But essentially, every item, every mechanical component has
segregation, cost segregation. Is that, or
that's the final effect of what we're doing. Okay. How it applies to multifamily, though, is that what I call, I'll just say the statement: today's cash flow is tomorrow's capex. So here you are going along and you're collecting your cash flow and you think you're doing great. You're supposed to be. This is why the IRS treats us so preferentially with taxes, with depreciation. They're recognizing that stuff is depreciating. And what that is not really some kind of a voodoo number thing. They're saying to us, you're going to have to replace that furnace. You're going to have to replace that water. You better be putting money aside. And to help you, we will go ahead and allow you to save on taxes. Well, how many of us do you think, in actuality, actually set money aside to be deployed at a later time when you do have to replace those things?
I would guess the number's not many. I know if you look at many brokers sales offers, there's little if any mention, especially
Correct.
on the smaller deals.
Correct.
I think larger
Correct.
deals, they tend to have some sort of a reserve.
Correct. So on the big kind of the large scope of everything, then what we're talking about is, you think you have cash flow, but it's really a big question as to, over the long term, whether you're going to be able to keep that cash flow. And if you don't keep that cash flow and you still need to make investment returns, where do those returns come from? Appreciation. Okay.
Right.
The next bullet point I want to mention is this. Imagine you bought a house for $100,000. And imagine 3 years later, you have to replace a furnace for $3,200 in that house. Would you feel okay doing it if now the house is worth $135,000?
Sure.
Sure. Would you feel okay doing it if the house is still worth 100,000?
I mean, not as much, but you got to have heat, right?
Well, you got to have heat, but at some point you feel like you're throwing good money after bad.
Right.
So is appreciation optional, or is it required in order for you to be able to hold on to the property long term and to feel good about it? Don't answer that question. It's rhetorical. I'm leading you in a direction. Okay.
Right.
And the final thing is, right after investors ask me how much money I'm projecting I'll be able to make them, they immediately ask me when they can have their money back. And sometimes those questions are reversed in order. First, they want to know when they get it back. Then they want to know how much money they make. So you put all those things together and you realize that the exit is really the most important thing, because we're talking about equity. I'm not going to give them their money back out of the cash flow. It's just not structurally possible. So therefore, I need appreciation. And then I can either refinance or sell in order to give people their money back. And I can refinance or sell or feel good about deploying capital into appreciated value by way of CapEx cycles, right?
Right.
So what I see when I see syndicated multifamilies, I see a flip. It may take 3 years, or may take 5 years, or may take 10 years, but ultimately it's a slow flip. I got to sell it for a whole lot more money than what I've got in the purchase price plus the renovations. Well, if you back that further out and you ask yourself, well, how's the value teed up in multifamily? And you answer, well, value in multifamily is a function of the income. The more the income, the more the value, because we just capitalize the value. So that basically puts my back to the wall and says, I just can't be buying cash flow. What I need to be doing is buying assets where I can create additional value by creating additional income.
Wait. So create additional income. So that's essentially more of a function of the balance sheet there with the or the income statement, more of the revenue and expenses. Is that what you're?
Well, no, I mean, it's both, because
Okay.
if I want to buy this thing for $19 million and I want to sell it for $35 million, how do I do that? What I need
Gotcha.
to do is take the in-place net operating income, which is capitalized by the marketplace at 5 cap, and then I have to increase that net operating income to the level whereby when it's capitalized at 5 cap, it's now equal to $35 million, if that's what I want, in order to sell it. Or if I want to be more conservative, I need to say, okay, I know the market is capitalizing at 5 cap today, but let's just do it at 6 cap. Just to be conservative, let's just capitalize at 6 cap. So now I got to create even more NOI, because I'm penalizing myself on the cap rate. Okay.
Right.
But the entire process for me is in reverse. It's just like flipping a house. When you flip a house, you start with the after repaired value. From that, you subtract your repair costs. From that, you subtract your holding costs. From that, you subtract your finance costs. From that, you subtract your profit margin, and that will land you on your strike price, what you can afford to pay. Well, the same thing in multifamily. Here's where I need to sell it in order for the internal rate of return to my investors to be equal XYZ, something palatable, so people will actually invest in this enterprise. Well, how much can I afford to pay for it then? Well, here's my presumed exit that I need for the IRR, minus the repair cost, which is my capital expense budget, minus my profit margin. My holding costs are already built into the NOI because it's income minus expenses. So my holding costs are already there. So minus my profit margin, here's the strike. So, I mean, it sounds very easy. It's very complex because you're talking about years of financials, all synergizing into one essentially number, which is the internal rate of return. And there's a lot of inputs there that if you are wrong on those inputs, the whole thing is just going to be, if you're wrong this much, the whole thing is going to be that much apart, right?
Right, right. No,
But what I need you to understand is that cash flow has become a very sexy phrase. Cash flow this, cash flow that. You know, I was speaking to a potential investor who reached out to me and said, I have $100,000 to invest. I asked, how did you get this money? And this person said, well, I had a condo in Canada and I sold it. And I said to this person, was this a rental? And she says, yes. And I said, how much cash flow did you make? I said, none. She said, none. I said, how much money did you earn on this condo? She said, $100,000. I said, you make no cash flow here. You make $100,000 here, and you are telling me you want cash flow? When you know your own experience is telling you. Now, here's the difference. She got lucky. She was in Canada when everything was going up. So how do you merge the two? How do you acknowledge that, yes, we need cash flow because you can't afford to hold on to the building without cash flow. So you need a certain amount of cash flow. But where we're going to build our wealth is on the balance sheet. It's going to be because we sell for a whole lot more than what we paid. It's not going to be because of the cash flow we got.
Right, right.
Cash flow is going to buy us some flexibility, some breathing room, some maneuverability, some financing, chutzpah, call it whatever you want. Cash flow is very important, but it's subservient. It tees up the valuation.
Right. No, I totally appreciate your viewpoint and just even expressing the capital expense cycle. I think most of the people that I've talked to or heard speak about the topic of syndication and stuff, their window of hold is usually that 3 to 5 year window. And in that, they're doing a value add play possibly. And essentially, the cycle is never really, they never have to face the cycle head on because they're essentially, they're jumping into it with the chance to do a value add and get higher rents and stuff. And that's all built into their capital budget. And it almost kind of reinforces that notion of get rid of it, flip it faster rather than hang on to it for longer. Based on what you've just said here, the 8-year cycle. I'd never heard that stated as much, but it totally makes sense.
Except it's disingenuous what they're doing because nobody has a crystal ball. I am as bullish as they get on multifamily real estate today, but I do not have a crystal ball. I don't know when the market is going to change. I don't think for the next few years, but I don't know. But the fact of it is that I'm seeing offering memorandums. And as you know, cash flows are discounted the further out you go. Right. And I'm seeing offering memorandums that indicate 16 or 17% IRR on a 5-year hold, but they don't provide a 10-year hold. Why? Because they're growing their incomes at 3.5% over the 5 years, because that's the only way they can get to a decent IRR in the 5 years. But even they know they can't get away. Nobody's going to let them get away with growing their incomes year 6 through 10 by 3.5%, considering where we are in the cycle, right? And if they don't do that, then the 10-year IRR is going to look like your poop.
Right.
Okay.
Right.
So just to give you an example, this offer I'm making today, I am bringing on board. I'm bringing on board an additional $1.2 million in capital reserves on a 160 unit building. I'm bringing on board HVAC reserves, roof reserves, plumbing reserves. Aside for the capital expense budget of $2.4 million that we're going to throw at it in the first 2 years that has reserves built in, I'm bringing on board about $500,000 of operating capital. I don't see, and you have to underwrite a 10-year hold because you have to show people what the worst case scenario is going to look like. And the worst case scenario is the market is going to shift cycle. You're going to have to hold through the bottom of the cycle and sell on the back end of the cycle. Well, in order to do that, you got to be able to stay in the deal for 10 years. So for me, the metric I most look at, can I make this attractive enough, even if we stay for 10 years? 5 years is going to take care of itself. 3 years gets silly. 2 years is stupid. But can I make it 14% internal rate of return on a 10-year baseline? If I can, I like the deal. Very, very, very few deals will do that.
Well, and I just totally appreciate your long range view, because I think that, it's been stated for a couple of years now that, are we there yet? Or I guess the question's been asked, are we there yet? Are we there yet? Are we there yet? And unfortunately, cycles are something that you can only really tell truly looking in the rearview mirror exactly where you are. But I think all indications point to we're at the top, and
I'll disagree with you there.
You think?
Yeah.
All right.
I will disagree with you there. But that's beside the point. Listen, I don't want to be in for 10 years. I want to be in and out in 3. But as someone with a conscience, bringing $8 million of people's capital on board for a deal, I have to acknowledge the possibility that we have to stay in for 10 years, and it still has to make sense. This is all I'm saying. This is why I underwrite it.
No,
it's
I
not
think
because I want to be there for 10 years.
no, but I think you're doing your investors a huge service by recognizing that up front, as opposed to having kind of a shorter window, which doesn't allow you the flexibility if the market, does cycle, and you're trapped because your financing needs to be replaced, and rates are high, and demand is low, whereas you've got a longer runway to exit out of the property. I think that's totally smart.
Well, let's talk about the market, because I see a lot of nonsense out there. Our stated inflation goal from the Fed is what? 2%?
2%, yeah.
2%, okay? So essentially, if all we do is inflate every year by 2%, then we're setting new highs, correct?
Mm-hmm.
Okay, if all we do, okay? Now, what are some of the things going on in today's world? In today's world, population is growing, okay? In today's world, family formation is on the rise. In today's world, there are huge cross sections of population who do not want to be owners. The ownership rate is structurally down from where we were in the 80s and 90s, okay? What's going on in today's world is that the cost of construction has shot up, both in terms of labor and materials, to a point where the minimum income, the minimum rent you have to generate on new construction is such that people can't afford it. So something in the range of $800 to $1,200 has a structural advantage, a kind of a safety zone against new construction, against overbuilding, okay? Now, I looked this morning, Sam and I looked this morning at Chatham Financials. Chatham Financials is an insurer who sells insurances for floating rate mortgages. Banks make you buy an insurance policy that guarantees a certain range for your floater. These are professional insurance people who study this, sit there in the dark cubicles and study it, okay? The cost of this insurance has gone down by 75% over the past 6 months because they do not see the interest rates going up, in spite of all of the yields are inverting, this, that, the other, all of that nonsense going on. In spite of all that, the professionals don't see the interest rates going up. And today, this morning, we looked at their yield curve going out 3-4 years. All they see is 20 to 30 basis points up by 3 years from now. That's not 200, that's 20. They are in the business, like when I go to finance this deal, I'm going to get a bridge loan, which is going to be a floater, 3-year floater. I'm going to be forced by the lender to buy insurance from these guys or others like them. It's going to cost me literally maybe $20,000, whereas to insure $15 million, whereas I paid $50,000 8 months ago to insure half of that amount.
No, that's a good trend for the borrower, or the investor. Yeah.
You open your CNBC in the morning, and Trump wants interest rates lowered by 1%. This and that and the other. Personally, again, I don't have a crystal ball. I am inflating my cap rates every year of the hold just because it's the right thing to do. Do I really think the cap rates are going to go up? No, I don't. Because with the interest rates being where they are and the professionals projecting them to stay where they are, what's the reason? You've got full employment. You've got incomes on the rise. You've got family formation on the rise. You've got structural tenants, people who will never own a home in numbers greater than ever before in the last 50 years. And the interest rates being in the basement and not looking like they're going to go up. Why should the cap rates go up?
Yeah, no, I appreciate you speaking to that. It was kind of one of the questions I had written down. It's just kind of a little bit of a look at interest rates and stuff, and the way that you assess it and watch that.
It's not me. I'm not smart enough to assess it. I'm looking at people whose business it is to study this policy and to understand the markets to a much finer extent than I could possibly. I'm not an economist.
Right.
So all I'm doing is, the guys whose ass is on the line because if the interest rate goes higher than that range, they have to pay out.
Right. That's kind of like the house money in the casino there. That's why they stay in business, right?
That's right.
Yeah. No, I hadn't heard somebody describe it like that, but that makes complete sense to me. I mean, and it supports everything that I'm seeing. I think one of the things that I've come to recognize is that I think people are prone to prognosticate or view that the next cycle is going to look like the last cycle. But in fact, I think what I'm more prone to believe is that in each cycle we learn something new, because a lot of times the whatever the cause of the last cycle was, there's a fix that's been put in place so that won't happen again.
Right.
Yet the memory, the human memory is kind of like, oh my God, we're getting there again. It's going to happen just like it did. I remember exactly how it happened.
And you should, that's not a bad thing. You should, just because I don't believe the cap rates are going up, it's not how I underwrite. I price my exit on a much higher capitalization rate, presuming much higher interest rates. If it so happens that we do better than that, then we'll just simply overperform.
Right.
But I underwrite, here's our cap rate today. Let's start growing it on day one. Obviously, it won't be linear, but I don't have a crystal ball, so I can't tell you when and how it's going to go. I'm not going to try, but linearly, I'm going to grow it over X, period of years by Y amount. And if it doesn't happen, fantastic.
Ben, I want to ask you something about, you mentioned the capital budgets that you raise and put in place. Does that, or have you found that has enabled you to make distributions based on your funding your capital budgets properly and being well reserved, or have you just basically
So,
sat on the cash and told everybody we've got more cash, but we're waiting because we expect some expense? Or can you speak to that?
well, no, it's not so much that we expect expense, but the only way I'm backing into this value add, this being a flip, okay? The only way to do it is to buy highly mismanaged buildings that are not cash flowing. So in the first year or so, there isn't cash. In fact, for the first 6 months, typically we lose money because the rents are so low. Okay. If you buy a more stabilized asset, then there's no room on the upside. If there's no room on the upside, then you have more cash flow today, which makes you feel good. But you can't increase the value enough to be happy with the rate of return in the back, because the cash flows are discounted over time the longer you stay in the deal. And if you
Right.
truly underwrite the internal rate, you will find out that you're not happy with the rate you get purely on cash flow basis. So what happens in Phoenix in specific, and I'll just explain this dynamic to you because this is a high growth market. This is why I like it. People are saying, in terms of where to buy, I'm like, we're late in the cycle. I don't know what's going to happen tomorrow. I know it's expensive to buy here, but it's quality because jobs are here, because population is here, because diversified economy is here. I'd rather buy here at a low cap than buy somewhere else at a high cap, because when the downturn happens, guess what? Okay.
Right.
So I'd rather figure out how to buy at a low cap for it to make sense. Okay. So what does that mean? You're in a high growth market. What does that mean? That means there's no physical vacancy. In Phoenix, like typically when people speak of value add, you find a mismanaged building. And what does that mean? That means, 18% vacancy, 16% vacancy. So most of your value add is a function of getting people in those units and maybe putting some lipstick on the pig and raising rents $50, $75 across the board and call it done. That's it. Most of the bump to your NOI happens because you take it from 18% vacancy to 5% vacancy. Okay? That's
Right.
most of it.
Operational.
What do you think happens if you don't have that? In Phoenix, the last building we bought, the sub-market vacancy was at 2.6%. Even the most mismanaged buildings are full in Phoenix. Why? Because in that 800 to 1200 price point, you can't afford to build. So there's an incredible shortage of product. And guess what happens? In a growth market where there's a shortage of product, it stays full. So if you don't have physical vacancy that you can fill to bump up your NOI, guess what you need? You need to actually bump the rents a lot.
Right.
And that's why it's so difficult to find a deal, because for us, we need plus or minus $300 per unit. In other words, we're taking a $600 rental to a $900 rental. And some of it is economic loss recapture, and some of it is bumped to the renovation, but blended on a blended basis, it's about plus or minus $300. Well, what does that mean? That means that when we take the building over on day one, the revenue is extremely low because it's too low by, the function of $300 per door. So when you're taking it over, for us, we typically, if we can underwrite 2% cash and cash in the first year, we're happy with that. And we don't really expect the distribution until Q4. But, by the second year, your cash and cash is 5.5. By the third year, 8.5. And what happens though, is that we're buying, let's say at a 5 cap, but then by the end of year one, we're at 5.5 cap on our basis. By the end of year two, we're at like 6.5 cap. By the end of year 3, we're at 7.5 cap. We're at 7.5 cap on our basis in a market that trades at 5 cap. Do you know how much value resides in that 2.5 to 3 cap delta?
That's a
You're
big number.
essentially doubling your
Yeah.
purchase price.
No, that's very. I appreciate you just like spelling it out like that, because that's it. I mean, if
That's
you
it.
could, if
That's
you
it.
can make
And so first of all, at 7.5 to 8 cap, you can cash flow.
right,
You can actually reasonably make good cash flow at those numbers at 7.5 and 8 cap. But the game is about the value. What you are doing is well, let me look at this real quick. I'll just open it. I'll just tell you. Let's see here. So if we bought this thing at about $19 million, then by year 3, our value would be about $31 million.
that's a pretty quick increase in value. I mean, you've doubled. Well, actually, so you've added 50% of the value.
Right. So
Yeah.
if we pay 2.5, if we pay 19 million and spend 2.5 on the rehab,
Right.
so we're at 21.5.
No, that
You know,
works.
okay, those numbers will work, but you need those numbers. That's how I understand this deal on a 10-year basis only underwrites to 14.5 IRR. This is only 14.5 IRR. We're talking about increasing value by $10 million. And this is only 14.5% IRR if you do the numbers the right way. If you do the proper discount, if you don't inflate shit, if you do the numbers the right way. Imagine what would happen if you didn't have this appreciation. And by the way, that exit, the exit of, let's say, 35 million, that's a much higher cap rate, presumed. Okay? That's why everybody looks at 3 to 5 years, because you bought it. By year 3, it's stabilized. If you want another year of stable financials so you can show on the market, here's my trailing financials, they're stabilized, you sell sometime between year 4 and 5. That is what ideally happens, unless the cycle changes.
Right.
And then you have to stay longer.
Right. No, and again, to your underwriting model, you've proven your model out to 10 years. So you've got the time, if anything changes, you can, weather the storm or maintain it. I like it. Ben, if we can, I'd like to shift gears here just real quick. As I explained to you before we got on the call, before we started recording, by day I'm an insurance broker. And in insurance, we do a fair amount of risk management. There's essentially 3 strategies that we employ: either avoid the risk, minimize the risk, or transfer the risk. And as such, I've been asking my guests if they could take a look at what they're doing and for real estate investors, and if they could assess what they see as the biggest risk. And not necessarily looking for an insurance related answer, but if you could describe for the listeners and myself what you see is the biggest risk.
Well, the biggest risk is always you don't know what it is. And the stupidest thing you can do in real estate is to buy for cash flow without putting any thought into how you're going to get out. So for me, we've been talking about risk management all this time. I underwrite 10-year hold. What do you think that's for? It's not because I want to stay there for 10 years. It's because this is how I manage risk of what I don't know.
No, I think your focus on the exit strategy is exactly where it needs to be. And I think everything like you've laid out here, population growth, job growth,
You have to be in a hot market, like not hot because it's trendy, but
fundamentally hot.
right.
Yeah.
Structurally, job wise.
Right. Right. Ben, before we wrap up, where can the listeners go if they would like to learn more or connect with you?
Well, my website is www.justaskbenwhy. That's why.com. And you can find me on Bigger Pockets. You can find me on Facebook. You can find me on iTunes. You can find me on Stitcher. The podcast we just launched goes through this in a much more deep dive kind of way, in a much more organized way. And the podcast is called Multifamily Syndication Unscripted. So that's on iTunes. But yeah, directly I'm accessible on my website. And the email is, of course, ben@justaskbenwhy.com.
Got it. Ben, I want to say thanks for taking the time to talk. I've enjoyed it immensely and learned a lot, and hope we can do it again soon.
It's my pleasure. Thanks for having me.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.